how about let's apply some ratios to a public company? I know you are as excited as I am. We'll start with the current ratio. This measures short-term financial risk by showing a company's ability to generate enough cash to pay off all its debts once they become due. We'll apply this to Walmart. Looking at the balance sheet, if their current assets for 2020 was $61,806 million and their current liabilities was $77,790 million, the current ratio would be 0.794, or rounding up to 0.75. This means that for each dollar of current liabilities, Walmart has only 75 cents worth of current assets. That being said, due to the tight working capital requirements, companies in the retail sector generally have a very low current ratio, in the range of 0.5 to 1 times. So, for the industry, this isn't a bad number. Let's look at another public company, this time Amazon. From this balance sheet, we can see that current assets are $132,733,000 and current liabilities are $126,385,000. This gives us a ratio of 1.05. If we were to compare these ratios, we could conclude that Amazon has better liquidity management than Walmart, and that Walmart has a bigger stock of inventories than Amazon, and it would have to sell off inventory in order for it to fully pay its debts. Comparative industry information is out there for everyone to see. Use it when you run any ratio. Let's look at another ratio example. This one is a little more complex. Joseph's Voice Lessons has the following income statement for this year. You want to find out if Joseph is generating enough profit from his sales and lessons and whether operating costs and overhead costs are being contained. To do this, you will look at his net profit margin ratio. This ratio tells you how much net income he generates as a percentage of revenue. The formula is after-tax net profit divided by net sales. But to get these numbers, you need to do a little calculating. We take the total revenue of $6,400 and deduct variable costs of $1,700 as well as fixed costs of $350 to arrive at a net income of $4,350 for this period. If Joseph also had to pay interest and taxes, that too would have been deducted from revenues. The net profit margin is calculated by taking the ratio of net income to revenue. Net profit margin is calculated like this. A net profit margin of 68% means that for every dollar generated by Joseph's Voice Lessons in sales, the company kept 68 cents as profit. The net margin is an important measure of a company's overall profitability. Larger profit margins mean that more of every dollar in sales is kept as profit. Let's hear about the importance of ratios from an expert I know and respect.
So you've seen the conversation and probably read and heard about various ratios. There's current ratios, there are net profit margin ratios, and so on. And many of these are very important depending on the client that you're working with. There is no blanket, you should always run this one and you should always find this number and it should always be this rate or this range of ratios, because every industry is different. There are businesses that run with a very slim margin. And so if they had a 10% gross profit margin, they would think that is phenomenal. But then when they get to their net profit margin, they might be looking for 1% as their profit, and that might be really good. There are some that are running with no cost of sales. So their gross profit margin is 100% because there's no cost of sales. It's all revenue. Then they have their expenses and they might be looking for a 70% profit margin ratio. So there are different industries with different ratios, and it is going to be to you important to know what those are for the particular client in the industry. Keep in mind that many clients, again, are a bit overwhelmed by some of their numbers. Not that they're not intelligent, it's just something that can be a little intimidating for some clients. And so we can put those on our reports to help them get used to seeing it there, help them understand, help them realize that this is about creating a target of where they want to be going. And so that's the kind of thing that we look for. Now, you can look again at different industries, whether it's a roofing company, a construction company, a professional services company, a retailer. Each of them will have different ones. So having a general idea for a client that might be interested in ratios or that you think could benefit from understanding those, do some research on those for the ones that make the most sense for them. Compare it historically. If you have their information from a year ago, run those ratios and look at them. Compare that to where they are today. Has it gotten better or gotten worse? And what were the drivers of that? What happened there? Did they have a big change in their business? Did they hire more people? Did they have a big job that they did? Did they land a big contract? Did they lose a big contract? What were some of the things that may have changed? And as you are analyzing that information from a prior year to now or months ago to now, it might be even helpful to show that to the client. Help them see that information. Again, showing something at one point in time for a client often isn't going to tell the whole story that they need to know. Looking at those ratios year over year, period over period, can help them understand what's going on in their business, and they know their business better than anybody. So looking at that and then asking some questions about what may have changed in their business during that time period could help them also understand how that affects their ratios that they're looking for. And then being able to get into some specifics there. You may also find that there are certain ratios that make sense to you that you're able to then take and explain in a way that makes sense. Again, inventory turnover. Most clients that have inventory know what that means. We have purchased inventory. How fast does it take us to sell that and turn over that inventory and buy new inventory and so on? They're familiar with that. But even for those clients, not all of them have quick turnovers. Many of them are holding on to things for a long time. And so turnover is a different ratio, even depending on the type of inventory that they carry. So learning about that, applying the right ratios to each client, helping them to be able to take action on that or understand it for any outside third party that needs to know those numbers. That's what we're trying to do. And ultimately, as the bookkeeper, if we're keeping their books in good order, we're reconciling the accounts, we're making sure that the numbers represent what they're supposed to represent, and they are tying to more detailed reports and the information is accurate. Ultimately, those ratios are up to the business owner to affect. We're just making sure that they have good information so that they can run the reports, see the ratios, and then take action in their business based on the information you've presented to them.